It didn't end well necessarily because in 2001, I saw the crash too, or 2000, 2001. So
Mhm.
for me, it was like, as an associate, I was just a young associate. It was probably like 10 years of venture capital packed in 2 years. It was extreme intensity of doing investment.
Welcome to the Smart Venture Podcast. We're here to bring you the latest and greatest from the Silicon Valley, where unicorns roam and innovation never sleeps. We've got top investors, superstar founders, and well-known tech executives lined up to share their secrets on building and investing in successful companies. Just a quick disclaimer, while we may sound like financial geniuses, but please don't mistake us for your friendly neighborhood financial advisors. So let's get started and dive into the wild world of tech entrepreneurship. Great news for all our Smart Venture Podcast listeners. Since January 8th, I've been hosting a new daily live show, Venture with Grace, on LinkedIn Live at 9 a.m. PT every weekday. Follow me, Grace Gone, on LinkedIn to catch up on past episodes and stay updated with future ones. You will get insights from key industry players and have the chance to ask questions live. Don't forget to subscribe to the show on Apple Podcasts, Spotify, and our YouTube channel under the Live button. Join me on this journey and let's explore the world of innovation and investment together. Hi, Puni. Welcome to Smart Venture Podcast today.
Thanks, Grace. Great to be here.
First of all, I would love for the audience to get to know you a little bit more. So, prior to joining True Venture, you had your own journey in tech. And I think maybe we start with like the Mayfield Fellow. I feel like the
Yeah,
Mayfield Fellow is something really interesting. A lot of I heard the Instagram founder was Mayfield Fellow too.
he
So,
was. Yeah. Kevin
yeah.
Systrom was a Mayfield
Yeah,
fellow
so
too.
a lot of really cool investors were like Mayfield Fellow back then. So I wonder, why don't we start with your journey from like the Stanford era to where you're at now?
Yeah, no, happy to. Yeah, I think the Mayfield Fellows, there must be like 50, 60 companies that have been started out of that, just, from
Mhm.
students who came out of that program. But yeah, I was at Stanford early on, and it was actually the second year of the Mayfield Fellows. And back then it was called Technology Venture Co-op. And had a different name. It started by an incredible professor named Tom Byers, who I'm still very close to today, who
Mhm.
frankly really influenced me, and it opened up the whole world of startups and tech. I actually didn't know anything about startups, what that even meant. I think kids today are really well versed in all that, but the Mayfield Fellows was the first time I actually got exposure to all that, and it really changed the trajectory of my life. But it's a program where they take 11 or 12 students, and usually engineering background, and it's a 9-month work study program, and it's all about kind of teaching and exposing entrepreneurship. So you take a class for 3 months. It's only 11 or 12 of you, and then you work for 3 months at a startup, and then you come back and you take the class again. And I happened to get into the program in its second year, and then right in the middle of it, the Mayfield Fund, actually a guy named Mike Leventhal, who interviewed me to get into the program, who's actually a great mentor of mine and friend of mine, who
Mhm.
was a partner at Mayfield. He helped endow the program, and so it became the Mayfield Fellows. And
Mhm.
so my journey started there in startup world, and I worked in the summer, I worked for a company called CrossWorlds Software, which was an integration software company, and I worked in product management. And then I stayed at Stanford for my master's year in industrial engineering, and I decided to continue working there in product management. And so that was a tremendous experience. And then from there, it was interesting. I had my undergrad and master's, and I kind of followed the herd a little bit. A lot of people were going into consulting and banking. The startup world was still like, it was unclear, a little less clear, not as clear as it is today, where everybody just sort of startup, of course. But so I ended up going to JP Morgan after that, and I worked in Wall Street actually for
Mhm.
a little while. I was there for 6 months. It was pretty funny, but I was supposed to work in the San Francisco office, and they said, "Why don't you stay in New York for 6 months?" And it was like the greatest time ever because they put me up in an apartment, and I was like this young, whatever, 22-year-old or 23-year-old, and they're like, "Yeah, here, do bank." But it was a crazy time because it was about 98, 99. It was the height. It was the beginning of the height of the bubble of the internet. And so we didn't even have enough people to do the amount of IPOs that were coming through the door. And back then, companies were going public, if you can believe it, with like 10 million of revenue. And it was just, we used to measure the value of companies based on multiples of eyeballs and visitors coming in. It was just a crazy,
Mhm.
almost ridiculous time. And I ended up actually not because I was anything special, but leading IPOs because they just didn't have enough people. And so I
Mhm.
was this young kid helping lead IPOs and take companies going public and do a lot of M&A. And it was a lot of late nights and working like crazy. And so I ended up doing that in New York and then, actually in SF as well. My heart though wasn't in banking, I would say.
Mhm.
I liked it, but it was very transactional, great people and all that. But I needed to be kind of in that startup world ecosystem. And it's funny, I mentioned Mike Leventhal before, the guy who was a partner at Mayfield. Well, one day I'm at JP Morgan. He calls me up and he says, "Why don't you come over and work at the Mayfield Fund, which is a big venture capital fund that's still in existence today." And I'm like, "I don't even know what venture capital is." And he said, "Well, it doesn't really matter. Just come here and hang out and you'll enjoy the experience." So I decided to do that. I went into venture at a very young age,
Mhm.
more just to learn. It was kind of, I looked at it as kind of my MBA as a way to kind of get experience. In fact, I didn't know what I wanted to do, but I went in there at a very interesting time because I went in there at the height of, again, the bubble going up. I think I remember in 99, Mayfield did 52 deals that year. I think it was like one deal a week. That's how I remember
Mhm.
it. And it was
Mhm.
ridiculous. It was deal after deal after deal. And it was all this internet stuff at really, really high prices. It was crazy. And then,
Crazy.
yeah, it was a crazy time. And I
One
saw,
deal a week. I feel like nowadays, like people do like two deals a year. So,
well, it goes in waves, but that was such a height. It was that time when people were raising $1 billion fund, which was unheard of at that time. All the
Mhm.
firms were doing it up and down Sand Hill Road. It didn't end well necessarily because in 2001 I saw the crash too, or 2000, 2001. So
Mhm.
for me, it was like, as an associate, I was just a young associate. It was probably like 10 years of venture capital packed in 2 years. It was extreme intensity of doing investment at the height of a bubble and then watching an incredible crash come down and just figuring out how to adjust to all that. And I at that point said, you know, I needed to go into the operating world because I felt like that was part of what I wanted to do in my career. And the longer I stayed in venture capital, the longer I would kind of have no other skills, to be honest.
Mhm.
So
Mhm.
it's a weird sort of dichotomy. So I kind of wanted to get into the operating world. So I went to BEA Systems for 4 or 5 years. 4 years, BEA Systems was a software infrastructure company, a much bigger company. It was pretty scary getting a job at that time. It was around 2002, and the economy and the tech world had just completely went off a cliff. But it was a great opportunity. I worked in product strategy, product management, product marketing. I helped lead a division around RFID tech, and eventually, after I left, BA got bought by Oracle. And then I also went to another startup actually based in India, called
Mhm.
Geodesic, which was in the mobile messaging space. And we went public in India. I moved to India. I got married, moved to India, lived in Bombay. My parents are from India, but I've never lived there. So that was a whole other experience I could spend a lot of time on. But I had an incredible time there and ran product there. And then eventually, when I came back, True was just starting. True Ventures started in '06. I had known Phil Black, who was one of the founders, from my days at Mayfield, actually back in 99, 2000. We had talked about even starting a fund together way back then. And so he called me, we talked. Eventually, I joined True. It was interesting. It was like a 6 month kind of consulting almost gig. It was like, let's just see how it goes. Because I was like, should I start a company? Should I go into venture? I really didn't know what I wanted to do. And 15 years later, I'm still here. so,
Mhm.
so from that point on, it just really took off, and I couldn't be more blessed with the opportunity I had to be at True and with the people I work with. But that's a quick snapshot of all of it. Hope it wasn't too boring for you, but it's a little bit of an arc to get there.
Yeah, I feel like I just couldn't unheard of like the 52 deal a year situation because that is like the opposite of like my personal experience or like my observation these days. That's kind of unheard of. Like I wonder, what was a 10-year venture crash course mixed into 1 year kind of like? And then what were the 50, like what happened to the 52 deals that you guys like invested in? Did some of them, this is ventures of a numbers game after all? Like I wonder what is like the best deal versus like what is like the normal deal within that badge.
Yeah, it was a crazy time where there was an overexuberance in the market, and it
Mhm.
wasn't just Mayfield; it was everybody.
Mhm.
So what you were doing was betting that these markets were going to be huge going forward, whether it be some kind of auction marketplace or anything related to the internet. Could be e-commerce, B2B commerce. It was just like everything's going to the internet, and therefore, like, we need to be in there and we need to invest aggressively. And so, I don't remember all the data and the numbers, but for most firms, like, that period of time did not work out well at all. And it was just because you can draw parallels to what happened during this last crisis around COVID, where people were overpaying for companies, the market sizes were not what they thought they were going to be, and therefore you have a crash, and then you have to readjust and reset valuations or distill a lot of the portfolio. And so that's what I mean when you say 10 years of venture capital, because you see what overexuberance looks like and aggressive investing at really high prices and tons of companies. And then you also see what it's like on the other side to actually, course correct, adjust, reset strategy. Of course, I wasn't a partner or anything. I'm an associate, so I'm sort of watching from afar. But that was the process. Now, you have to find your medium. Like at True, we invest in 20 to 25 new deals a year. We're at the seed stage where we have a pretty high pace for what we like to do. There's other firms that will do 5 new deals a year. I mean, it depends on what your strategy is as a firm. That was veering away from what most firms were doing, and all of them were doing it because it was just, oh my God, the internet, we got to take advantage of it. So Mayfield wasn't alone in that position to go that aggressive.
Mm. I wonder when it comes to like building a fund these days, because I know that like, we could later on chat about like your operating experience in both India, like taking a company to IPO, or like previously you work at like an infrastructure company back then. But I feel like one of the like, you know, thing on your resume that like we could not talk about is like True Ventures, because I feel like you joined at a very early stage after like 2 years the company was formed, and like not the company, but the fund was formed, to like, now it's like 15 years later. And like, I feel like not many VC fund like make it to that long. Like, although, yeah, like I feel like especially nowadays, like I feel like observing the emerging manager ecosystem, like there's a new fund popping up like every few days. And I
Yeah.
wonder, how do you view building a successful venture fund look like? And I don't know if the emerging manager trend is a more current recent trend, or like if it was kind of popular back then, but like we just haven't heard of a lot of fun because of they kind of don't exist anymore.
Yeah. Yeah. I mean, the seed market when True started, so John Callahan and Phil Black started the fund, and they're still, running, still partners and very active in the fund, and
Mhm.
great mentors to me. But when True started, actually, it wasn't like what you're talking about today, where there's tons of seed managers. In fact, we had our first fund was about 165 million in 2006, and that was literally, I think, half of the entire seed market. So
Mhm.
there were only a few funds, and there was a massive dislocation in the market. That's, you can think of True as almost like a startup at that time. It was like we
Mhm.
saw an opportunity, we saw a hole in the market where there was a lack of kind of institutional seed funding, and
Mhm.
we went into that and then rode that wave in a leadership position. I mean, now we're a tiny percent of the overall seed market, which is billions and billions of dollars and tons of managers. Um, but I think the way to build a successful firm is to actually first decide that you want to build a successful firm. You have to be, very intentional. Do you want to be a manager who just raises a fund one time and therefore, hopes, just try to get successful and then see what happens? Or from the very beginning, do you want to build a 100-year firm? And
Mhm.
if you want to do it from the very beginning, then you have to set a strategy.
Mhm.
You have to hire people, you have to scale people, you have to set a whole set of cultural norms that define you, that create differentiation in the marketplace. I think the biggest thing that's interesting is that, True is actually structurally pretty different. There's not a lot of funds that lead rounds at very early seed stages and then stay all the way through, and also invest so much in community and so much in team. So structurally, we created a differentiation in the marketplace versus like, hey, I'm just going to start a fund and I have a network and let's just see what happens. I'm going to be like with the other 100 folks and hopefully it'll all work out, right? Whereas if you can create structure differentiation early, and we led with EQ, we led with the founder as a customer, we led with concepts of maximizing risk. Those were all new, unique ideas, and those are still hallmarks of the fund today. So we still believe in creating a long-term fund that lasts forever. So you have to be intentional from the early days to do it. Otherwise, I think if you backtrack into it, you're not going to get there. It's like any company too. If you're like building a company to sort of flip it, you're not going to ever build the components or the foundation inside of it to make it last for a long period of time.
I wonder when, like, what differentiated, like, so you mentioned like structure differentiation and then like basically also like, founders, your customer, and then these are a lot of like fundamental like thinking to it. And I wonder, like, in terms of day to day, like, what would you say were things that like make True differentiated to, a lot of other funds? And I wonder, I guess, like, what would you say were, let's say, three things that corely like True has done differently that like versus like a fund that just like, couldn't be able to raise a, second fund.
Yeah, I think it's a great question, and there's a bunch of things I can point to, but I would say that the three things that I would say are: one is that we've always had this tenet around not trying to be right at that
Hmm.
first check, but trying to have the right ingredients. And when you do that, everything is team-based. So we
Hmm.
don't work in silos as individuals. A way to think about it is we're playing basketball. We're not playing tennis, and we truly fundamentally created that in the culture because by saying that you don't have to be right in that first check, we assume we're going to, 50% of the companies are going to fail. We're at the seed level, right? So there's a high failure rate that's associated with it. But if you build it into the model and you free the investors to sort of say it's okay to not be right in the beginning, then you free all the finger pointing and all like, putting people in the doghouse, and you actually create a team-based culture that can last for a long time. That's not all about attribution. And it's not about, one single person did this deal or this person did that deal. We as a collective did the deal. And a lot of people play lip service to that, but I really believe we live that, which allows us to be liberated and allows the folks that we invest in to be liberated because we don't bring our fear into the boardroom. Like, it's like if I'm worried about my track record and my deal and this dollar amount that I'm putting in, I'm going to bring all those insecurities into that boardroom, and that founder is going to feel that. And so that was a big kind of moment where we said it's going to be very much team based. We're just about getting the ingredients right. And we know that, it's going to come down to 2 to 10 deals that really make the fund, but it's like there's no way to predict it right at the beginning, right?
Mm.
There's this sort of, that's a hardcore cultural tenet. Another big cultural tenet I would say is just the idea that we want to maximize risk on product market timing. So we always talk about that. That same bullet point about maximizing risk has been on a slide in every single one of True's presentations to LPs since the beginning of '06. So
Mm.
it's always there. And so what we're doing is trying to push ourselves on the market side, but again, in this framework that you don't have to be right because
Mhm.
you can't, you don't fundamentally know, but let's push ourselves to see if we can get there. So that allowed us again to go after multiple spaces that a lot of people would not. We were very early investing in hardware. People didn't even think you could invest in enterprise software in the early days in C. People didn't think you could do biology in C. People didn't think you could do all kinds of deep tech type stuff that we're doing, e-commerce, marketplace. So we kind of went into these markets because we wanted to take a lot of risk. And we minimized risk because again, it was small dollars. It was not that we want to lose it, but it was okay to lose it. And we wouldn't point fingers at each other. And
Mm.
so those big cultural tenets were very, very big for us. And then having a bigger fund, because um, if you can put money in and follow on all the way through, which most seed funds cannot, and then you had the bigger funds, they didn't want to do seed deals because they were bigger funds and they're doing A, B, C deals. That left a big vacuum for us to actually go do that. And that, if you can do that and get ownership early on, you can drive fund level returns even in bad vintage years or good vintage years. So that was a big thing. And then the third thing I would say is maybe I've done four, but I'm going to do it anyway, is community. We
Mhm.
really bet on the community. And we have an entire platform team that is, former CEOs, former big execs, and the connectivity that we provide among the team, I think, is powerful, but among our founders. But the biggest thing is the cultural tone of it, is that everyone there is raw, like raw and honest about the struggles of the journey. And it's a flywheel for us. 70% of our deal flow actually comes from existing founders. So it's roughly somewhere around that number. So if you can invest in a founder, give them an incredible experience, allow them to be raw, honest, have no fears about talking about what's really going on, and be a true partner to them. And
Mhm.
then they refer you deals, and that sort of cycle continues. So it's those factors that I think define us even to this day. And we continue to just keep building on that foundation.
I wonder, as for like, I want to double click on like the 70% deals from existing founders. I would say it's good that like founders have like a good, True has like a really good reputation among the existing founder community. But as for like, I guess like, what would be you also mentioned about like the having the right ingredient. What does that entail? Because I kind of feel like for one of my concern, if I were like in the position of like having founder recommending me other founder in their network, obviously I have to vet the first founder first, right? Like, so if you invest in them and they happen to be amazing, but I wonder if the best deal from True, meaning like the companies that like eventually have the best exits, are they typically are from the 70% deal flow from the existing founders, or would you say it's more of like the other like 30%?
Yeah, I would say it's a bit of a mix, actually. It's
Mhm.
important to make sure that you mine your founder network, especially if you've built
Mhm.
a strong founder network to begin with. But remember, it's another 30% plus that is outside of that network.
Mhm.
But I would say I'm just thinking about, the Pelotons, the Duos, the Rings, the HashiCorps. I mean,
Mhm.
a lot of them actually came from the founder network, and they didn't come from necessarily, founders that had a successful exit per se. So that's not a requirement.
Mhm.
It's more like great founders. It doesn't always work out. It doesn't mean that if the exit doesn't work out, doesn't mean that that
Mhm.
founder doesn't have great intuition, or is, just ran into a market that didn't work. But it does oftentimes come from existing founders,
Mhm.
and that, or I would say people that we've known in the network. Now, to the ingredients for us, just to go back to that point, are great founder, which has a number of subcomponents that we can always get into. Great market, but the market is typically small when we invest right at the beginning because it's early. So it's a market that is coming. So what's the entry point and what's the big vision? And then, the deal structure, because we want to make sure that we're getting the right level of ownership that's fair, but that can drive fund level returns. And so if those three ingredients align, and we can vet the opportunity very quickly with our existing founders, and our existing founders who we highly respect are saying this is a great opportunity, like that's an opportunity that we want to jump on very quickly
Mhm.
and go after. But you're right in the sense that you have to be, you can never rest, and you can never sit back and just say, let deal flow come to me from my existing founders. You have to be out there, you have to be in networks. One of my partners, Tony Conrad, likes to say it's a contact sport. If you want to know, you got to go. Right? So you got to
I
be
love
out
it.
there in the flow. We're in discords, we're at events,
Mhm.
we're at stuff. We're also asking our founders constantly, what are they seeing? What are they excited about? But
Mhm.
yeah, a large majority of our best wins have come from existing founders.
I wonder when it comes to like, I guess, like, evaluating the right ingredient, like, what would you say? I think, like, obviously, the founder have to be tenacious, like, they have to, be really smart, like, very curious, quickly learning, quick learner, etc. I guess, like, what would be, like, something that True Venture look for, like, specifically in terms of, like, figuring out who is, like, a good potential portfolio company for True itself?
Yeah, I mean, it does come back to those ingredients a lot. Like, so one thing is that we don't have a consensus-driven partnership. So meaning that, one partner and some other folks on the team like it, others may not like it. And the reason for that is we don't want to, push for lowest common denominator where everyone's like, okay, that seems great. We're trying to push
Mhm.
ourselves to maximize on the market. For us, I would say from a founder perspective, the couple things beyond obviously tenacity, great storytelling, but it's the why, what is driving that person to go after this problem? How do they view this problem? How do they think about it? It's not that you have to have all the answers, but it's sort of how you answer the questions, if that
Mhm.
makes sense. And then a market, it's really interesting because I would say we're trying to swing for the fences there. So oftentimes we get hung up a lot on like, is this really a big enough market? And the answer is you don't really know, but can you see through the eyes of that founder and that founder articulate like a massive trend that we're riding or a possible trend? Like, it may not be that that trend will happen. It just may not be, but we're willing to make the investment knowing that there is a potential for a massive trend to occur, right?
Mhm.
Because and that trend has to occur within 2 to 5 years, right?
Mhm.
So we really look at like, is it truly big enough? Are we thinking big enough? Are we pushing ourselves? Are we uncomfortable with this
Mhm.
market? Are we a little bit uncomfortable even with this investment? Like those are things that we're testing with each other. I think those are the biggest things for us. Again, it goes back to that same point I brought up before. Are we taking enough risk? And we want to make sure we're taking a lot of risk with that first check.
I have two questions associated with the risk taking part. I feel like for every venture fund, eventually the game is to like generate returns, right? And I wonder, like, in terms of like the valuation part, a lot of the, really the craziest deals, like it's hard to figure out like what would be like a good valuation. Especially in like, let's say currently, we're under like a AI giant AI wave right now. So like I feel like investing in an AI company now, it's probably like 2 to 5 years too late. I wouldn't say that. I feel like AI still have like a huge possibility of like, generating amazing returns from today's age. But like it's a lot harder to pull from because right now it has so much attention, so much noise in general. I would love to learn more about like, in terms of valuation, how would you like what kind of valuation are you looking for to like invest when it comes to these kind of like popular deals? And you mentioned like, you want to see something like if this trend would take off in like 2 to 5 years, what are some sectors or subsectors that you feel like it's really exciting today?
Yeah, I would say despite what is out there and what people read about high valuations, which are always out there, except
Mhm.
oftentimes in down markets, but there are we are in the early innings of AI and there are a crazy number of opportunities there. And we are still getting the kind of investments that we like to do. We typically are that kind of 1 to 3-ish million, 1 to 4 million early check, and in that valuation range of sort of 12 to 20 posts somewhere in there. And when we invest, it's really early, right? So
Mhm.
there's oftentimes no product. It's 1 to 5 people. It's just a vision and a story. Sometimes there is some basic product. So we are finding lots of opportunities there. Now there are exceptions, of course, but like I think if you don't have a core strategy that you live around, that is defines sort of what you like to do, then it's very hard to define like what an exception is. So we know what our exceptions are, and when we do them, we're very excited about them, and we push forward with those. But at least we have a kind of a framework that we live around. Because if you don't, it's very hard to on a fund by fund basis. On a singular fund, it may be okay where the exception becomes the rule, and you blow out some fund, you have a small fund, and it blows up because he invested in something at a high valuation, but it ended up, being an incredible exit. But on a fund by fund basis, if you want to have consistent returns, that's somewhat hard to do. And so that's where we tend to play. And I can tell you there's plenty of opportunity. And I can tell you also that there's a lot of founders who are incredible founders. We have a lot of repeat founders coming back who have done incredibly well and can raise at any price, who actually want to do that kind of investment because it actually sets the company up the right way for success down the road. If you raise too much at too high of a price too early, that creates a whole set of other pressures, and
Mhm.
also it sets up the company to build in a certain way that maybe they shouldn't be building that way at the very, very earliest stage. So that's where we tend to focus.
Um, is there any particular area that you feel like have a good area potential, like, the next wave of AI? I know that True is like, I've been following True like from a long time ago, but I think like when it first like quote unquote took off into my eye was like I was following Kevin Rose, who are like a past guest on the show, and then I feel like he has really like seen NFT or like the crypto whole like spectrum like a lot earlier than a lot of other funders, which I thought were like really cool that someone could see something from like a long time ago. And then wonder if there's something that like currently you feel like are exciting that's gonna kind of pop off in like 2 to 5 years.
Yeah, I mean, I think as I said before, I think we're still really early on the AI front, but I think it's in several areas. Like
Yeah.
the cool part is it's happening everywhere. And so, even the data center itself, right? Like the
Yeah.
amount of power that's going to be required just to handle all this inference is crazy. I mean, I read somewhere that, if Google changed its interface like to a chat GPT type interface, it would, require the amount of power that Ireland consumes, right? Like just by
Mhm.
itself. And so if the data center is being reinvented, that means, like we've invested recently in nuclear power, right? For example, we're looking at how chips are being reinvented. We're looking at how networking equipment is being erected, optical networking equipment, all kinds of stuff, like every
Mhm.
cooling, right? Like what does the data center infrastructure actually look like? And then at the infrastructure layer, all of that is being redone too. And so from observability to security to DevOps to all components of it. And then at the app layer, I think it's still really, really unknown. We don't know what kind of social construct will be built because of AI. We don't know what the apps are actually going to be. Like, I know you can sort of look at it and say, well, there's going to be like another version of marketing automation or there's Salesforce automation. I agree with all that too. But there's stuff we haven't even heard of or thought of because of this new paradigm and way we're looking at stuff. And then there's verticals like we're doing a ton in biology, the marriage of biology and data and healthcare data. I think that is a massive market, but I think it's going to extend to areas like manufacturing and fintech and other areas too. So that's very big in itself. But by the way, we love to invest in areas where people aren't looking to. We're continuing to invest in crypto. We're continuing to invest heavily in robotics, in climate tech, in e-commerce, consumer. There are plenty of opportunities that will still exist in all these areas for sure. And so for us, we're broad, but it's about finding great founders who take us into great markets as opposed to being too heavily thesis driven. We have strong opinions because we've all started companies or been in industry or been around VC for a long time, but it's meeting as many people who are at the edges, as we call it, who are experimenting with different things and trying new types of things that we tend to just follow. That's how
I'm
we.
so yeah, I'm so fascinated by what you said about like the data center and like, the you guys invest in like the nuclear power company. Like, can you chat a little bit on that? I don't know if it's public information. Why don't we just cover like the space, how the money flow in the space and like what does building a data center mean in terms of, funding that in that space and then how the money flow in the industry basically.
Yeah, it's stealth right now, that company. That the answer is I don't exactly know how the money will flow yet. What we do know is that the existing grid that we have is not good enough for if you think
Mhm.
that AI is going to take off in the way it is already taking off and will continue
Mhm.
to, which means so much has to be reinvented. We're going to
Mhm.
continue to do and find entrepreneurs that fit our hypothesis of investing sort of smaller dollars up front, spending time getting a lot of data, but we think we can do that. There are going to be NVIDIA can't own it all. There's going to be different types of chip companies that be created. There's going to have to be new networking equipment that's going to be created. There's going to have to be all kinds of stuff within the data center that has to be created. So what we're doing right now is it's so early that we're just looking for people who are experimenting with this and talking to folks in our network who have done this in the past and what they think is coming. But as far as the money flowing, for us, that's what it means for the money to flow. Like you're going to have to rebuild these in unique ways. We're not going to get into a game of competing on billion-dollar build outs of data centers. What we're going to probably look for is where are the enablers of how to do that, and what are you going to need to unlock some of that potential value.
From a fund perspective, like how does the fund math work in terms of like portfolio construction? Would you say you would spend like I guess like in terms of like giving us any specific, maybe you could walk us through on like, how to if you're like like let's say if you're like a first time fund manager as an emerging manager, because some of our listeners are emerging managers, and what would be the thinking framework between like behind like, creating a successful fund on a fund level? Because a lot of these are very high, sounds like they're like very high risk area companies. Those are like could be very, yeah, like it could be very, very risky. Like, a lot of things are not what people are familiar with. So maybe their less investor goes into it, especially in the robotics or like any hardware sector. I wonder, yeah, like how would you like, I guess, advise like the people who are like more earlier stage in their fund journey to kind of like on this specific topic?
Yeah, I mean, I think you have to think about what matches your own skill set and what you think can be successful. What's the system that you can create? And I think you have to think about it from that, like kind of a systems thinking sort of mentality a little bit. The book, I don't know if you've read the book, the Power Law book on venture capital. A lot of people have
Mhm.
read it. It's a great book. It's got, a lot of great insights, but it is true. The business is a very much a power law business. And, in any fund, it comes down to a few companies that really, and when they return a multiple of the fund, they typically return multiples of the fund in itself. And then there's a set of companies behind that also do well, but not as well as sort of these massive fund makers, right? There's probably
Mhm.
another 8 or 10 behind that. And then there's a whole set of companies that you assume are going to go to zero, just number wise, and that there's a high failure rate. So you have to build failure into your model. And if you don't, then you're kind of building, you're in a different game. You're in kind of a private equity game where, you
Mhm.
assume that nothing can fail, right? And you're sort of playing for 1.5 to 2x kind of returns on a much bigger fund. And so yeah, there's a couple things. You got to build failure into the model. You got to build it in a way that it's not half the dollars that say, let's say half the companies fail. It's not half the dollars that are going out, but it's a much smaller subset of those dollars because you're able to see and get a bunch of data as to when and distill quickly as things go. The biggest danger in venture capital for an emerging manager is that you're putting too much money too far along in a company and then that company fails. That can affect a fund in a massive way. So you have to think about failure rate, distillation of those dollars in sort of the correct amount of time. And then, do you have enough, I would say, shots on goal in a way to make sure that given the way you're looking at deals and the kinds of deals you're looking at, that you can eventually get to those two or three that can get, to that power law type return. And that comes from a lot of, deal flow being having a unique model, which I talked a lot about, making sure you're getting the right kind of opportunities to look at. And then if you do that a certain number of times a fund, that those will pop out. But I mean, I think you have to be very thoughtful and intentional about portfolio construction in terms of the number of deals that you're looking at, the number that you think can fail, the dollars that you think you're going to lose, and then how you can get to a point where a few of those can pop out and be big. And that comes down to strategy and deal flow and a lot of things. But there's a lot of thinking and science that has gone into what we've done over the years.
I wonder when it comes to the sector we were just talking about, because I think they were extremely fascinating. Like, I know that, like you mentioned, like, I feel like you guys are more founder driven than, like, I know that you mentioned you have strong thesis on certain things or strong opinion on certain things,
Yeah.
but like, it's not so good to like focus too much on the thesis. I completely agree because I feel like the founder they knows a lot more stuff than
Yeah.
like most of the investors. And
100%.
I wonder how, like, I guess like what would be something that you hold as an opinion? I guess like how do you create like a thinking framework in an industry that's very new? So let's say the nuclear company, like I guess like what I'm trying to ask is like how do you examine if something is financially going to be viable? Because I think like creating a new type of technology is one thing, but like can they be commercialized? That's like a
Yeah.
different set of game, right? And I feel like as investor, it's like probably really important to pay attention to who would be the buyer and like how is this thing going to be commercialized from like, coming out of the lab. Basically, I guess like what's your like diligence process on like what to back instead of like, oh, this is a really cool thing to happen, that kind of thing.
Yeah. I mean, I believe that you can do very good diligence and thorough diligence, and you can do it fast. So I don't think
Right.
like you need to do it. There's with our networks and the founders and all that's out there, we can move fast and get very thorough information. And you have to be willing to live in a world of imperfect information. So you're not going to get the perfect answers. But can you form a hypothesis that gets you excited? Because a lot of
Mhm.
this is instinct too. There's art and there's science. Like you've got to develop the deal instinct. I always say, like, as an early investor, you've got to learn to trust yourself. And then as you get later on in the years, you got to learn to doubt yourself because you don't want to have your biases from the past. But so there's an instinct part of this that you have to, rely on a bit. And
Mhm.
so you look at the technology, you say, wow, look at the founder. Wow, like this is some really interesting. I also think people forget a lot about, well, is there any business model innovation here? Is there something unique in terms of how they're getting to market, who they're getting to market to, how they can sell? We don't know for sure if that is going to happen, but you're absolutely right, Grace, that like you have to have a viewpoint that the money will flow somehow, right?
Mhm.
In some way, that there are buyers out there. And if we look at that, like we'll see if there's not a large universe of buyers, or this is very single threaded. Do we want to take that risk or do we not? There's heavy competition in this space. This is just too incremental, right? You have to look at like all these various things. Like when we did Duo Security way back, which was a great exit for us, right? The innovation there was that they democratized the actual selling model in addition to the technology, but they democratized the selling model of two-factor authentication. It's a security product, but they actually got it out of the hands of the top 100 customers and actually got it to everybody else. And that in and of itself was an innovation, even though there were multiple companies in the space, right? So we're
Mhm.
looking for companies that are either reinventing the current market or creating a new market, and that exists on both the vector of product and technology and business model, if that makes sense.
I'm taking notes. I wonder in terms of like reinventing, like creating a new market, right? And I think like so for example, like I would say like if I were like an earlier stage investor who are in like investing in the NFT space before like 2021 or like 2020, I would like not be able to identify that was a new market. And I wonder what is like a definition or like what would be something tangible to evaluate if something could become a market versus like something that's like an imaginary market. Like, if we build X, like we may have like, customer to funnel into Y. Because I feel like this could also apply to like a overall broad spectrum of things like Airbnb. Like,
Yeah,
people have been like, if I were an investor who even encountered them earlier, I would be like, why don't people just use Craigslist and like, it exists, right? Or like, I feel like it's hard for people to like tell if something will become a market. I don't know if there's any kind of like benchmark that you use to be like, this is actually like, fundamentally makes sense then like.
yeah, it's not. I don't think there's a benchmark, at least at the early stages. I think it's the narrative that comes from the founder. Like, when we did Fitbit or we did Peloton, right? It's like,
Mhm.
so you can say the same thing about Fitbit. It's like a pedometer. Like you go to the drugstore down the street and you would see all these like little pedometers sitting in in the shelf. You'd be like, forget it. It's another pedometer. But the unlock of the creation of a new market was connected fitness, right?
Mhm.
So you have to fundamentally believe that this founder who is articulating this vision will actually create something new. And we're willing to make that investment because James Park, who founded Fitbit, was an incredible founder, came from an incredible
Mhm.
recommendation that we got, and sort of articulated this really interesting vision. And it was just small dollars for us, right? Out
Mhm.
of a larger fund. That's the whole, like bringing it back to kind of how we operate. The framework enables you to take a ton of risk on ideas that who knows will work or not, right? Peloton, similar idea. It's like, oh, it's a bike. No, it's not really a bike. It's also another variation and rethinking of connected fitness, but so much of it came from the thinking of, John Foley, right? And I
Mhm.
could say the same thing about, a Duo or a HashiCorp or some of the other big ones we've been involved with. The founder all had an unlock that they had envisioned that you could choose to believe or not believe.
Mhm.
But when you meet a great founder who is, thinking about a massive trend and you're just leaning forward, you should lean in and you should just go for it. And that's what the beauty of the model is, again, that we can lean in with smaller dollars that are only a tiny percentage of the overall fund. And again, we don't have to be right. We're not judging ourselves on that. So that's how I think it's part unlocking your inhibitions as an investor, and then it's part the founder and the narrative.
I have like a another question in that kind of like sector. So when like HashiCorp or like Peloton or like all these company like you guys invested, were they very different from like what it is today? Because or like was the founder kind of like keep on pivoting into wherever it is now? Or like did that are these companies just their original vision that they were able to just like execute off
Yeah, I
that?
would say they definitely executed off of like a core vision. So it's yes and no. Like there's definitely aspects that stayed all the way through. Like I don't think any of those companies actually went away from the core roots of what they were trying to do, whether it be democratize security or, create a whole category of connected fitness. But along the way, there's tons of decisions around product, market, variations on people and hiring and where you want to head. Probably the biggest one I would say, HashiCorp had a different, like when we invested in Mitchell, it was just him and, and Armand actually, and they had incredible open source traction around a product called Vagrant. That wasn't what eventually defined HashiCorp, the company. It was two other open source projects that sort of defined it, Vault and Terraform. But the roots of open source and the vision to change cloud infrastructure were always there, right?
Mm.
And the same thing with sort of other plays that we've been involved with, right? So, Peloton, obviously the bike was a big factor. We invested a little bit later. That was sort of an exception for us, but again, very early in its life cycle. But that then went from connected bike, then all the kind of content they were creating, plus additional products, a whole bunch of series of things that started to evolve. But it's actually interesting. It's not, contrary to what a lot of people say, it's not like a full-on pivot away from where it started. It's not the Slack story.
Mm.
There are those. There are those that are out there, but it's kind of rare to be like in a completely different left field, not in something that's not working, and then figure out the unlock and grow it. There are companies in our portfolio done that. Like we have a company called Forward, which is in the government spending space that started in one area and shifted, and then just completely took off in another direction. But that's pretty rare to see that happen.
Mm. Also, a question on like second or first time founder, because I feel like a lot of the more people I talk to, the more I feel like I'm hearing a lot of the more experienced founder are tend to have a more successful company. I wonder what's your thought on like first time founder? Let's say like a younger founder didn't have much experience, kind of like went through YC and then like started a company versus or like a PhD program. After a PhD program, they started like a company based on some sort of technology, and then they are trying to find use cases that will pay them a lot of money kind of thing. Versus like, a senior executive left like a big tech like a Google or Meta or like Amazon or something, like come out and then created something that's like in their sector because they kind of own the distribution or like they kind of like know the problem already exists. I guess like I'm sure like both type of founder would find success somehow, but like I wonder what's your thought on your observation, who are more easier having a success and like what kind of like are the challenges for these two type of people that you feel like should be aware of, people should be aware of.
Yeah, I mean, I think you're right. Both can have success, and we've had situations where both have had success. I think that it comes back to what I said earlier, which is a bit about the why. Like, what is the
Mm.
motivation motivation of that individual. Like, I think you have to kind of measure the chip on an individual's shoulder, whatever that measure is.
Mhm.
But it's kind of like, how badly and how much does that individual just want to win and change the industry? Because you know as well as I that, like, it's not a straight line. You're going to run into so many problems. There's so many opportunities to just throw your hands up in the air and say, I'm not going to go forward on it. And so one of the pitfalls, so what we're trying to see is like that why and that chip on that shoulder, and that can come from both places. The danger of someone who has been very successful or who has made it, quote unquote, is just to make sure, like, that intrinsic motivation is there. And you can be motivated way beyond money, but you got to make sure that it's there if someone has already had a big success. And we know that that can be there, but we also know that that cannot be there. Same thing with a big company exec coming. If a big company, this is classic, but big company execs coming down to a startup with no infrastructure, that is a harder play typically. Now, there are absolute exceptions to that in our portfolio as well. But again, it's a lot of like, are you ready for this? Like, do you understand what you're getting into? You probably don't, but
Mhm.
do you want to learn? Do you want to sacrifice? Do you want to give up, do what it takes to make it? And that's why first time founders are also a lot of fun, because it's like, they don't know what they don't know, in the sense of, like, you're going into something. I think Jensen Wang said that, the Nvidia founder and CEO, he's like, if I knew what I was going into, I wouldn't do this, right? Like, there's power in not knowing, and just jumping in, and also bringing a pair of fresh eyes to something that you've never seen before. So I think it's the chip. The chip on that shoulder is what we're really looking for, and that can come from any kind of background, but I think you got to have it.
Can you give us an example of like what is like the most interesting chip on the shoulder story? Because I feel like it's Silicon Valley. Everybody's driven somehow. Like I know, like I feel like even for the executive who are made it at like a big tech, that's not easy too. Like so they probably had to have like they went through the thing. So, but like as like a first time founder, you are going through the thing. So like it's very different. So I wonder what would be like a good example of like chip on someone's shoulder that kind of like drives them.
Yeah, I mean, I think it's hard. Like, you don't know it till you really see it with a first time founder. But I'll give you like an example. I mean, there's a company we're involved with, called Understory, which is in the insurance space, tech enabled insurance space, and they build a
Mhm.
sensor that measures all these different dimensions of rain, hail, and from that they can offer a really novel insurance product. It's a very hard industry to crack, because insurance is just like that. You have to have relationships with all these different individuals, the reinsurers, the fronters. There's a lot of red tape, a lot of regulation. And we funded a guy named Alex Kubicek, who lives in Wisconsin, and people are like, okay, there's a lot of stigma. How can you build a company in Wisconsin? We ignored all that. And then was a PhD in basically like weather patterns and hail out of the University of Wisconsin. But just in talking and meeting to him, you could see he was someone who wanted to make a dent in the universe and change this. And the reason I bring him up as an example is we probably, died 5 times in the process of trying to create the company, or were near death, and just because, like, almost there and then some relationship or this or that. But like every time, I've just rarely seen such level of grit. He would just keep going, keep going. And now the company has turned around. You're going to hear some announcements about the company, but it's an incredible story of just the fortitude required to keep going. And that encapsulated it to me, of a PhD out of Wisconsin, who, just in the way he talked to us and his vision and his story, and then he saw it in real life, which is like, I mean, the number of times where we were out of money, or just couldn't get over some hump, or just felt like there was no way out, he never would give up. Never. So part of the challenge is, though, I wouldn't have known that unless we went through it, but I had a real good sense that he had it in him.
Talking about like never gave up. So I wonder what would be the benchmark of like someone should give up or like should switch idea to something else. Like I guess like I think like the biggest fear of like a company is not like off the bat it's like not working like that. I guess the founder already pivoted into something else, or like it's kind of like working in a big way. That's like you just keep doubling down whatever that is. But what if it's like some part is working, some part is not working, or it's kind of like a myth? So like they're like not going to becoming like the biggest thing ever, but they're kind of like working enough to be like, hey, we have some customer, but it's just like not a lot. I wonder how would you kind of like advise these kind of companies?
Oh yeah, this happens a lot. And by the way, in the understory example, the reason that we kept going was we kept seeing like signs that the opportunity was big. And so we just kept going for it. But you're right, there's lots of opportunities where it's not like that. And I think where what really comes into play there is trust and honesty with your investor about this stuff. Like if you're trying to hide the ball or you're just trying to do it for the sake of doing it because you feel like you owe somebody something or it's your ego, like that's where you get into trouble. But the best thing is just to be honest and clear about what you are seeing as a group right up front. And then there's plenty of options. Like we've been in situations where, again, this is where by being liberated and not being, too stressed about, what this means for my track record type of mentality, where we've been like, hey, look, like I think we both see this is not working. And by the way, when you have that conversation, it's a total relief typically for the founder, and they know it. They just needed
Mhm.
someone to say it and get that release valve going. And we've been in that situation, said, okay, well, why don't we try something else?
Mhm.
And we have money, let's go try something else. And that's fine. Like
Mhm.
you are empowered to go do that if you have the right partner and investor. There's no use in banging your head against a market that's just not forming or is too far out or is not out there.
Mhm.
And so we're very open about that kind of conversation, and it happens a lot. And the other thing is, if it's not working or you're like the mid example, that may be a place where you're like, okay, maybe it's time to sell the company or find a home for the company and then move on to something else. Because the biggest cost, as you know, is time, right? If you're just spending time for the wrong reasons and you're not having that honest conversation with your investor or yourself, you're just hurting yourself because you could be doing something incredibly valuable. Most of these folks are just so talented, you just get stuck in the wrong market.
Wow, totally. I completely agree. And I know we're about to hit the time. I want to like do like a quick fire round with you.
Sure.
So I've listened to your past interviews and I actually listened to the book you mentioned in the last interview. It was like the Malaysian fraud guy.
Oh,
Yeah,
okay.
that one. Yeah,
Yeah,
yeah.
I
That was
forgot
a
about
long time
that.
ago. Like I listened to that book recently, just like because I think like for prepping our interview since like the last one we chat, I like just went off to like listen to the whole book. It was such an interesting book. I also bought like the similar book to the thing. So like what is something that you're currently reading that's kind of like pique your interest?
Yeah, it's interesting.
It's a
I'm
good book recommendation. It's like pretty dramatic and it was like really interesting to like just like think.
yeah, it's so the book that I I'm a bit late to this book, but it was like so fascinating to me and I couldn't put it down was Open by Andre Agassi, and it's his autobiography of the tennis player. So hopefully people know who Andre Agassi is. And the book starts off by saying, he starts the book by saying, I hate tennis. I mean, here's like an 8 time
Mhm.
or 7 time champion. And it literally talks about his whole life and how he hated the sport. But in a weird way, the sport also gave so much to him. And you can't even put it down. But that journey of how his parents or his father just pushed him into it, to him rebelling, to him finding his voice and who he was. It's kind of a journey that like kind of everybody goes through. His is obviously like has much more flair and is much more dramatic, but I couldn't put the book down. And I honestly like I have friends who don't even know anything about tennis who also couldn't put that book down. It just captures you right from the beginning and you just want to hear it. And it's a story of a person's life. And I love those are the books I love the most. Just
You have
curiosity.
good taste in books. You have good taste in books. I would love to like I'm definitely gonna like immediately buy it after this conversation. Who made the biggest impact in your career?
Wow, who made the biggest impact? That's a big one. It's very hard to say one, but I would say it started probably with my professor, Tom Byers at Stanford, who introduced me to the Mayfield Fellows program because that opened my eyes. But then it's probably like Mike Leventhal who helped who was a partner at Mayfield, who then is, I mean, all these people, by the way, have become friends, and then I would say just in the venture side, my partners at True, all of them and especially John and Phil and, an individual, Kevin Compton, who used to be at Kleiner Perkins, I'm very close to him as well. And then, my father and family, I think every day make a huge impact on me. I know the question was about career, but they just push me in ways that, are life lessons that I think
Mhm.
impact your career as well.
Mm, who would you invite to your dinner party?
Who would I invite to a dinner party, you said?
To your dinner party.
Living or dead or anybody?
It's your party.
I would probably have, the first person that popped in my head was like a Gandhi. Like, like I came from, my father and parents immigrated from India, and my parents immigrated from India in 1969. So I grew up in a household of immigrants, and that culture of India really, resonated with me because we were really only the only people of color in sort of our neighborhood, but just we were kind of this little cabal, and learning about India and its culture was always very fascinating to me. But yet I'm an Indian American, right? Like I grew up in America. So I have ties to India, but I'm not born and bred there in a way. And
Mhm.
so I would just love to kind of go back to that root and those roots and spend time and understand as best I can. So that's probably the first person that popped in my head. That's the first person that popped in my head.
Where can we find you outside of work?
Oh gosh, I have three kids. I have a 15, 13, and 9-year-old, and it is crazy busy with all their. So it's a lot of time spending with them. My middle son is crazy into tennis, so you'll find me a lot at like different tennis tours. My daughter's like really into singing, and so I
Oh my
love.
God, a talented family.
I don't know where they got it from, but I will tell you that they're like mentors to me too, even though they're young kids, because I learn so much from them every day, and I admire. They do things that I could never do, which is just amazing to watch. And my youngest is amazing too. And so it's a lot of time with family, a lot of travel. We love to travel and explore and spend time. But that's the stage I'm in my life, where it's a lot of there's really family and work, and there's very little other oxygen out there to spend and do other things. And I am drowning in a lot of ways, but I kind of like it. It's fun drowning because I love what I do at work and I love what I do with my family.
Amazing. Well, Puni, thank you so much for coming on the show today. It was such a fun conversation.
Yeah, thank you, Grace. You have a wonderful podcast, and it's really an honor to be here.
Thanks for tuning into Smart Venture Podcast. If you learned something from the episode or even just mildly tolerated me, please subscribe and leave a 5-star rating. I promise I will keep bringing you more successful, insightful interviews and insider tips about startups. Remember, sharing is caring. So tell your friends to listen too, or enemies, I won't judge. Until next time, keep venturing smartly.